Richard Hunter, Head of Markets, and welcome to our look ahead for the week commencing the 4th of October. The final week of September and indeed the third quarter has been a very difficult one for markets. Indeed, the US indices posted their worst monthly performance in September since the outbreak of the pandemic in 2020. There's a litany of concerns at the moment, both in the States and on the general global economic stage. Obviously, we've got elevated inflation, we've got supply chain issues. There's also the additional problem now of what's going to happen around the US debt ceiling, and of course further evidence of slowing growth in China. So the outlook going into the final quarter of the year, the fourth quarter, is rather unsettled at the moment. We've seen some resilience from the FTSE 100, which hasn't quite taken the bashing that the other indices have seen in the last week, although much of that is simply down to the weakness of sterling on broader UK economic concerns and also the strength of the dollar, which of course a weaker sterling, generally speaking, is good for the FTSE 100, where around 70% of earnings are coming from overseas. Despite the unsettled outlook at the moment, the indices nonetheless remain fairly healthily ahead in the year to date. The Dow Jones is currently up 10.6%, S&P 500 14.7%, Nasdaq 12.1%, and our own FTSE 100 is up 8.7%. Turning to next week, before we get into the third quarter reporting season proper, there's a couple of companies worth keeping an eye out for. We're expecting half-year numbers from Tesco. Tesco shares are up about 19% over the last year. When we last heard from them in June, they had posted some extremely strong online sales figures. They've been ramping up their distribution capabilities, which is clearly maintaining the company's market share. It's obviously the largest supermarket in the UK by some considerable distance. At the same time, clothing and general merchandising sales were on the way up. A couple of things to look out for when the half-year numbers come through. The height of the costs that Tesco and indeed other supermarkets had to undertake because of pandemic changes, obviously on a comparative basis, will start to fall away. That could potentially turbocharge the figures. And also any other news on its dividend. Shares are currently yielding 4.3%, clearly punchy in the current interest rate environment. Also, a third quarter trading update from Greggs. These shares are up 150% over the last year, a fairly stellar performance. We last heard from them in August when they reinstated their dividend. Half-year sales have pretty much recovered to pre-pandemic levels and was certainly very much strongly ahead of last year in the midst of the pandemic. Profit was therefore sharply up as well. So the question now is how trading has been faring after most of the restrictions, of course, have now been lifted. Thank you for watching. Have a great week.